Bitcoin, from an obscure digital experiment to a global financial phenomenon, its journey from zero to over $70,000 has redefined wealth. Is this truly the digital gold of our era? Let's dissect its history and market alpha. What's driving Bitcoin's unprecedented ascent? This asset, once deemed worthless, has consistently defied predictions of its demise. Its trajectory is a masterclass in market dynamics and technological disruption. Let's dig into the data. Remember Bitcoin Pizza Day? 10,000 BTC for 2 pizzas? That's a transaction now worth hundreds of millions. This historical anomaly encapsulates Bitcoin's exponential value appreciation and its journey from novelty to necessity. Unpack that alpha. At its core, Bitcoin is a decentralized digital currency. No central bank, no single administrator. It's peer-to-peer electronic cash, verifiable through cryptography, transacting without intermediaries. This autonomy is fundamental to its appeal and market thesis. The backbone is the blockchain, an immutable, append-only distributed ledger. Every transaction is cryptographically linked in a chain of blocks, ensuring transparency and security. This architectural innovation underpins Bitcoin's integrity and trust model. Transaction validation relies on mining. This process, using proof of work, secures the network, verifies transactions, and adds new blocks. Miners solve complex puzzles, earning newly minted Bitcoin. It's energy-intensive, but vital for network security. A critical supply dynamic is the halving. Approximately every 4 years, the reward for mining new blocks is cut in half. This pre-programmed event drastically impacts supply scarcity, historically preceding major bull runs. Mark this in your calendar. Bitcoin's maximum supply is fixed at 21 million coins. This hard cap, combined with the halving cycles, establishes its inherent scarcity. It's a fundamental economic principle. Limited supply against growing demand drives value, much like precious metals. Behind this revolutionary creation is the enigmatic Satoshi Nakamoto, an anonymous entity whose identity remains unknown. Publishing the white paper and launching the network, Satoshi seeded a global financial paradigm shift. The mystery adds to the legend. The journey began in 2008. The Bitcoin, a peer-to-peer electronic cash system, white paper was published by Satoshi Nakamoto, outlining the framework for a novel digital currency. This seminal document laid the groundwork for everything we see today. January 3, 2009, the Genesis block was mined. Bitcoin was born. The first transaction soon followed between Satoshi and developer Hal Finney, proving the network's functionality. A quiet but profound inception for a global phenomenon. Fast forward to 2010, Laszlo Hanyecz made history with the first real-world Bitcoin transaction, buying 2 pizzas for 10,000 BTC. A fun fact, yes, but also a stark reminder of Bitcoin's nascent value and its incredible growth potential. In 2011, Bitcoin achieved parity with the US dollar, hitting $1. This early milestone was quickly followed by significant volatility, introducing the market to Bitcoin's unpredictable price action. Early adopters felt the full force of rapid swings. Observing the charts from this period, the Relative Strength Index, or RSI, frequently hit extreme overbought and oversold territories. This early technical footprint demonstrated high speculative interest and nascent market illiquidity. Extreme volatility was the norm. 2012 brought the first Bitcoin halving. Block rewards slashed from 50 BTC to 25 BTC. This event demonstrably constrained supply, setting the stage for future price appreciation. Understanding halving cycles is paramount for long-term holders. The market reacted decisively in 2013. Bitcoin surged from approximately $13 to over $1,100. This parabolic move was catalyzed by events like the Cyprus banking crisis, driving mainstream awareness and a narrative of Bitcoin as a safe haven asset. This period saw the rise of fear of missing out, or FOMO. Early speculative buying, fueled by rapid price gains, created a feedback loop. Market psychology amplified the rally, attracting new retail investors. A classic bubble pattern emerged. For assets with exponential growth like Bitcoin, logarithmic charts are crucial. They normalize percentage changes, revealing long-term trends and cyclical patterns that linear charts obscure. This provides a clearer perspective on macro movements. The year 2014 brought a major setback, the collapse of Mt. Gox. Once the largest Bitcoin exchange, it disclosed a loss of 850,000 Bitcoin, sending shockwaves through the nascent market. This event severely eroded investor confidence. Market sentiment shifted drastically. FUD, or fear, uncertainty, and doubt, dominated narratives. Mainstream media questioned Bitcoin's viability, leading to widespread skepticism and a prolonged bear market. This tested the conviction of early believers. Regulatory uncertainty also played a significant role. Governments worldwide grappled with how to classify and regulate cryptocurrencies, creating an environment of caution for institutional players. Clarity was and remains a key driver for broader adoption. Lessons from Mt. Gox underscored the paramount importance of risk management, secure storage, diversified holdings, and due diligence on exchanges. This incident, while painful, matured the ecosystem and fostered improved security protocols. Always protect your capital. In
In 2016, the second Bitcoin halving occurred, reducing block rewards to 12.5 BTC. As expected, this further constrained supply, setting the stage for the next market cycle. These pre-programmed events are foundational to Bitcoin's economic model. The year 2017 witnessed a massive bull run, pushing Bitcoin near $20,000. This surge was amplified by the launch of Bitcoin futures contracts on CME Group and Cboe, signaling growing institutional interest and legitimacy, a landmark year for crypto. The introduction of regulated futures marked a turning point. It provided a gateway for institutional players to gain exposure to Bitcoin without direct spot purchases, diversifying hedging strategies and portfolio allocations. Smart money began watching closely. Retail FOMO reached fever pitch. Everyday investors witnessing the incredible gains poured capital into Bitcoin. This speculative frenzy drove prices to unsustainable levels, creating peak exuberance. Understanding market cycles prevents emotional trading. Volume analysis during this period was crucial. High trading volume accompanying significant price movements provided confirmation of strength and conviction. Conversely, declining volume during rallies often signals weakening momentum. Always cross-reference price with volume. Then came the infamous 2018 crypto winter. Bitcoin's price crashed by over 80% from its peak, entering a prolonged bear market. This period was characterized by significant capitulation and a reevaluation of the entire crypto space. The Bitcoin is dead narrative resurfaced with intensity. Widespread FUD led many to abandon their positions, further exacerbating the downturn. However, history shows these periods of extreme pessimism often present generational accumulation opportunities for the patient investor. Technically, traders look to key moving averages, particularly the 200-day MA, to identify potential support levels. A death cross, where a short-term MA crosses below a long-term MA, often signals continued downside pressure. These indicators are vital for trend analysis. Despite the crash, the digital gold narrative strengthened. Proponents argued Bitcoin's scarcity and decentralized nature made it a superior store of value, resilient against inflation and traditional financial instability. Conviction held through the storm. 2020 ushered in the third Bitcoin halving, reducing block rewards to 6.25 BTC. This was a pivotal moment coinciding with a burgeoning macroeconomic shift and the onset of unprecedented monetary easing worldwide. The stage was set for another powerful cycle. Institutional interest exploded. Companies like MicroStrategy began aggressively allocating significant portions of their corporate treasuries to Bitcoin, signaling serious conviction in its long-term value proposition. This was a game changer for market perception. The macroeconomic environment became a major tailwind. Fears of inflation and unprecedented fiat money printing drove investors towards scarce assets. Bitcoin, with its fixed supply, emerged as a compelling hedge against currency debasement, a powerful fundamental driver. The decentralization narrative resonated strongly in an era of financial instability and government intervention. Bitcoin offered an alternative, a hedge against traditional systems, appealing to those seeking sovereign control over their wealth. It's a fundamental ideological appeal. With increasing clarity and growing conviction, institutional capital inflows accelerated. Hedge funds, pension funds, and corporations initiated strategic allocations, legitimizing Bitcoin as a viable, investable asset class. This influx of smart money changed the market structure. Technically, chartists observed golden crosses as short-term moving averages definitively crossed above long-term ones. These robust buy signals confirmed the end of the bear market and the onset of a new powerful uptrend. Trend reversal confirmed. 2021 was a year of new all-time highs, with Bitcoin surging past $60,000. This rally showcased its resilience and increased mainstream acceptance. The market was roaring, driven by both retail and institutional momentum, a new peak achieved. A truly historic moment, El Salvador adopted Bitcoin as legal tender. This bold move by a sovereign nation provided an unprecedented use case and pushed the boundaries of monetary policy. It was a clear signal of Bitcoin's growing global influence. Major corporate treasuries followed MicroStrategy's lead, adding Bitcoin to their balance sheets. This strategic diversification demonstrated a belief in Bitcoin as a superior store of value compared to depreciating fiat currencies, a powerful endorsement. Technological advancements also progressed. The Lightning Network, for instance, significantly enhanced Bitcoin's scalability, enabling faster and cheaper microtransactions. This development addressed a key criticism and expanded Bitcoin's utility beyond just a store of value. During explosive uptrends, Fibonacci extension levels became crucial for identifying potential price targets beyond previous highs. Traders utilized these tools to project future resistance and manage profit-taking strategies. Predictive analytics in action. 2022 brought another challenging bear market, characterized by major collapses. The implosion of Terra Luna, a significant algorithmic stablecoin project, sent shockwaves across the entire crypto ecosystem. Contagion risks became apparent. The FTX exchange collapse and its founder's subsequent legal troubles was a devastating blow to market trust. This incident exposed severe centralized exchange risks and highlighted the critical importance of self-custody. Centralized failures underscored decentralized value. These events spurred increased scrutiny and calls for stricter regulatory frameworks globally. While challenging in the short term, clearer regulation can foster greater institutional participation and long-term stability. The market demands robust oversight. Market sentiment was heavily negative, leading to widespread capitulation among weaker hands. This period of extreme FUD often cleanses the market, shaking out speculative excess and setting the stage for recovery as fundamental investors accumulate. Patience is key. These downturns powerfully reinforce risk management principles. Appropriate position sizing and mandatory stop-loss orders are paramount when dealing with Bitcoin's extreme volatility. Protecting capital is always the first priority in these markets. Fast forward to 2024. The US approved spot Bitcoin ETFs. This monumental decision opened the floodgates for mainstream institutional capital, making Bitcoin accessible to a much broader investor base through regulated products, a true paradigm shift. The approval immediately drove significant institutional capital inflow. Billions of dollars poured into these ETFs, creating unprecedented demand pressure on Bitcoin's already constrained supply. This fundamentally alters the market's demand-supply dynamics. Result, new all-time highs, surpassing $73,000. The ETF impact was immediate and profound, demonstrating the latent institutional demand. This latest surge reaffirms Bitcoin's position as a premier asset for capital appreciation. The market has spoken. The spot ETF approval legitimizes Bitcoin as a mainstream asset class. It removes many barriers for traditional investors, integrating crypto into the broader financial ecosystem. This marks a new era of adoption and institutional confidence, a watershed moment. The core thesis holds. Scarcity meets accelerating demand. With a fixed supply and consistent halving events, the added demand from ETFs creates a powerful supply shock dynamic. This fundamental driver is a powerful indicator for